M&A offers have hit the big league. This week alone, there's already been more than $46 billion offered into the M&A market for potential deals. This BHP potash is a big part of that. Joining us this morning to discuss the current M&A market is Bob Profusek. He's the head of mergers and acquisitions for Jones Day, New York. And Bob, great to have you with us. And we just want to note, though, for our viewers that you're actually involved in this potash deal, which is why you can't talk about it in detail, well, we know.
I can't talk about potash too much. I'm representing potash in that deal.
Right, but it's just all the more fitting as to why we have you here, though, because you're in the middle of this action. And, you know, we were debating about whether or not the premiums put out on some of these deals that we've seen in the last couple of weeks. Does that signal that there's more confidence going on among CEOs and in the economy?
Well, certainly the macro factors are pushing indicating a much more active M&A market. I actually have my own personal M&A index, which is the black car index. How many black cars do you see at 10 o'clock at night parked in front of tall buildings in Manhattan? And I'm telling you,
and are you seeing more?
A lot of them. I must say this is, particularly for August, which is obviously a little bit of a lull month, usually. Yeah. Mm-hmm. There is no August this August. There's a lot in the pipeline. Now, having said that, one of the things that's really unique in my almost 30 years at this is that while the pipeline is absolutely bursting, getting from inception to completion is still a tricky process. There's still a sense of risk aversion that's impacting things.
And a lot of CEOs are paid not to look stupid, right? Which means that if you've been working on a deal for months and ultimately it's not going to work out, then you don't pull the trigger. What is the most common question you get from CEOs today on whether they're going to go ahead with a deal or not?
Well, it's at two levels. There is a focus on legal and due diligence that's much more enhanced than there used to be. Sure, big companies have always been careful and they look at stuff. I know there's a sense that people get ego in the way and do that. That isn't the real world. On the other hand, the sort of risk aversion stage we're in terms of just business in general has required an intense amount of risk. One of the things that does is elongate the deal process, and the longer things stretch out, the more likely it is that something gets in the way and screws it up. So that's a big factor. But the one thing is CEOs don't want to look stupid, not just to their boards, but to shareholders. Shareholders are very active participants in this. This is one I was not involved in, but to me it was fascinating, was Cadbury Kraft a couple of months ago. You know, there was a lot of criticism, including by some pretty heavyweight shareholders, right, about whether that was wise. That's not a good position to put yourself in as a CEO.
And how much of the debate or the hang-up has been around valuation? Because for a long time, you always heard this thing that sellers and buyers just couldn't be meeting in the middle. We had the stock market that rallied 60% last year. We had, you know, a lot of people who thought valuations were too low. So you find this disconnect there. Have that started to stabilize yet?
Whenever you're coming out of a major correction, and I guess correction is an understatement for what we went through in 08, 09, there's always a dislocation effect. People look backwards. I'm not going to talk about potash, but this is a fact, so not an opinion. Potash was trading at $250 before the collapse of Lehman. This offers at $130. Now, I'm not saying that $250 is an intrinsic value or any other number, but you know, it's hard to make things match up in that kind of environment. The one thing there is, and this is different from just 4 or 5, 6 months ago, is there's plenty of money. Financing things is not an issue. Certainly for investment grade markets, the investment debt markets have been just on a tear in the last several weeks.
But you're saying there's a lot of cash out there?
There's tons of cash, and there's tons of cash on corporate balance sheets. One of the things about this period, while everybody keeps thinking, including myself, that we're going to see a lot of private equity activity because they've got a lot of commitments that are starting to expire because you either use it or lose it when you're a private equity firm.
Right.
This has been a strategically dominated period by and large.
Right.
But that's not a surprise. The Commerce Department said that the S&P 500 companies had $1.95 trillion of cash on their balance sheets at June 30.
Okay. That's a lot of money. Okay, Bob, we'll have to leave it there.